Hello class and welcome to our 13th lecture series on managerial accounting, and I'm your instructor Jamal Haider. Okay, today we are starting chapter 9, which is profit planning and budgeting. So our first learning objective is understand why organizations budget and the processes they use to create budgets. So number one, a budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified forthcoming time period, which means a budget is basically a forecasting, right? And it is a forecasting technique, but in specifically it is quantitative forecasting technique. It's not like that sales gonna increase, no. How much percentage or what is the concrete number that sales going to be increased by which number and what will be our new sales. So the act of preparing the budget is called budgeting. It means the process of forecasting and preparing these forms and tabular statements, we call that budgeting. So the use of budgets to control as organizations' activities is known as budgetary control. Now, question arises, what are the uses of budget? So budgets can be used as a control purpose as well. For example, if you're seeing the expenses budget, if your expense is increasing, the amount you requested, the controller over there, he may refuse to pay that because he has no authority to pay over from this budget. So in that case, it creates a control over the organizational activities as well, so that our expenses must be, controlled, right? So planning and controlling in budgeting part. So when we use as a budget as a planning purpose, so planning involves developing objectives and preparing various budgets to achieve those objectives. So there are two purposes of budgets. Number one is planning. Number two is control. So when we use budgets as a control, so control involves the steps taken by the management to increase the likelihood that the objectives set down while planning are attained, and that all parts of the organizations are working towards the goals, so that you are not detract. Whatever you have planned, so you are according to the plan or not. If you deviate from the plan, then the control triggers, and then what happens? You need feedback, you need reevaluation, so you need some kind of performance, like who is responsible for which kind of activities. So these steps triggered, right? So purpose of the budgeting are planning and control. Planning means you're preparing or developing objectives, you're forecasting different kind of objectives, and controlling is that whether you are fulfilling your plan objectives or not, whether you are deviating from the planned objectives or not, right? So these clip arts really explained what we meant here, right? So the advantages of budgeting, they are, first of all, number one, you cannot start the process of budgeting without when you have a defined goals and objectives. So number one advantage is that you would be having a definite goals and defined goals and objectives. Number two, so think about and plan for the future, right? So budgeting involves forecasting forthcoming period, next period. So it also gives us insight that what will be happening in future, and what will be our goal. Should we want to expand? Should we want to increase the sale? Should we want to decrease the sale? Or should our focus is just for profit? And it's like that. The third one is the means of allocating resources. When you budget, you forecast, then you define that, okay, this much is my salary that I will be paying, in in respect of the salaries. This one is for acquiring raw material. So you are basically allocating the resources from where? From your cash inflows. What are the cash inflows? Recall our discussion of cash budget. So what are the cash collections? That you have a sales and customer paid you the money. So your cash collections, you receive tons of cash. Now where those cash are going to be allocated? How much salaries we need to pay? How much inventory we need to produce, right? How much R&D we need to put some cash into that one. So this is the benefit of having budgeting as well. And then it also uncover potential bottlenecks as well. So if something is not, you are not good at, you can outsource, right? So you plan and you develop the marketing budget, and you realize that your marketing budget, although was huge, but still your marketing personnel, your marketing employees, they fail to attract, or they fail to bring those specific number of orders on which you basically base your forecasting. So it also gives you your potential, drawbacks, your weaknesses as well. What if you find out that your HR is very nice, and whatever you discuss, they hired so much competent person that you exactly follow the budgeting process? It means you basically uncover your strengths as well. Plus, budgetings are a good way to communicate plans. So rather than just having a formal meeting, just present those concrete numbers that this would be our future. We are going from this much to that much, 10% increase in sales. We're gonna be, 10% increase in sales, gonna increase our profit by how much, right? Plus, it's a coordinated, coordinated activities. We'll see that. So it means the budgets depends on some master budget. So there is a master budget, and everyone is depending on that one. We'll talk about that. For example, sales, salaries budget depends on some other budget from which you collect the amount and you pay the salaries, right? Responsibility accounting. This is very nice and very emerging concept, is that managers should be held responsible for only those items, and only those items that they can actually control to a significant extent. So I just gave you the example of marketing personnel that they fail to attract, or they fail to bring these specific orders. Now, whose fault is this? Because we don't have any, good numbers of orders. So of course we will be having a loss, but our production department will say that, look, we did our best. We produce according to the plan. We should be given bonuses. It's not our fault, right? On the other hand, what if the marketing department says that we bring too much orders, and the production department, they failed to produce? The production department will say that we cannot produce more than that. This is our 100% capacity. The marketing department will say that, to hell with you. We don't care about that. Our job is to bring orders, and that's it. So there's a constant fight, and there's a constant blame game between marketing department and production department, right? So who would be, responsible in that situation? So we name that term responsibility accounting, so that others should be given, others should be given rewards and bonuses because they did really hard, or they, work hard to fulfill those budgeted amount of figures. And only those people who are responsible up to some extent, significant extent, they will be punished according to their, deprived of bonuses or whatsoever the scenario would be, right? So responsibility accounting means you are responsible for those things which are under your control. But which kind of control? Significant control. So choosing the budget period. So normally the budgeting covers 1 year, but you can develop quarterly, monthly, weekly, 5-year, 10-year plan as well, right? It depends on your focus as well. So a continuous budget is that. So a continuous budget is a 12-month budget that rolls forward 1 month as the current month is complete. Basically, you make a monthly budget, and based on your previous month's performance, you make a new budget. Just like continuous, process. We call this continuous budgeting. So the another famous type of budget is called self-imposed budget. So the idea is that when you forecast, you give some kind of objective that, like sales department, you need to sell this much amount of goods. You need to, take this much orders. For production department, you set the, budget that you have to produce 100,000 units of the goods, right? The question arises, sometimes the employees, they feel that they are, given forcefully these kind of objectives. Since top management, they live in, head offices, very nice luxury buildings, they work in ACs, they have the cars, they don't know the ground realities, right? So all they need to do, they just see the numbers and they give us the objectives, and that's it. Sometimes it looks impractical. So in order to remove that barrier, and it's true as well, because if I am the manager, I don't know how this product is going to be made. So I just basically look at the numbers and try to push the employees. So last time you produced 1,000 units, why not you